Jim, what do you want to hear most from the Federal Reserve today?
Okay, what I would like to hear is that don't worry, we understand the hazards of going back into recession. We will do what's necessary. We intend to keep rates low. We'll try to get long-term rates even lower. But we need the cooperation of Congress and the President to be able to take these rates and either have housing be refinanced, give us a way out to use these rates, and maybe issue $200 billion in bonds. In other words, what he has to do is not just say, listen, I'm going to get rates lower, but here's what you need to do with them. And the reason I say that is because rates are really low and nothing's happened.
What do you think is going to happen?
Well, I mean, I think that Bernanke very rarely gets the benefit of the doubt, but we've had a lot of rallies off Bernanke. I also think that, as a stock guy, I look at stocks as being long-dated assets. And if I can look at a Clorox, let's use that example, and it's doubled its dividend in 5 years, it yields 3 and change. I look at that versus the 10-year or the 30-year. It makes stocks more attractive. And I think caught up in all of this is that it doesn't necessarily make Union Pacific more attractive until it gets to a level where the dividend's good, the yield's good. But it does make companies that yield 3 as opposed to just 4 more attractive.
What other names would you be looking at then as we see a rally?
Well, I mean, Stephanie and I are buying some more Unilever. That's a good example.
Right.
We kicked around the notion of a General Mills because it was a very good quarter. It suddenly highlights 3% names, and 3% names that have 2 to 4% growth instead of the 1 to 2% growth of the U.S. economy are going to come into the fore here because of this.
All right, great takeaway. 3% yielders. Thanks, Jim.
Yes.